Well, if you go back over the last 15 to 20 years, there certainly have been a heightened focus on the area of finance, with obviously a lot of the coverage that is now out there in the media world, but also the focus on the decisions being made that can have an impact on our economy. But what does that mean for us right now, especially in a time frame where we've been coming out of the pandemic and now we're also dealing with inflation? Pleasure to be joined right now by Loretta Mester, who is the former president of the Cleveland Federal Reserve Bank. She is now an adjunct professor of finance here at the Wharton School. Loretta, great to have you with us today. Thanks for your time.
Thanks for having me on.
Thank you. I guess let's start with your view of where this economy kind of stands at the moment.
Yeah, well, what's interesting about the economy is that if you think back to the beginning of the year, the economy really started on a really strong note. Businesses were very optimistic. They were really looking forward to deregulation because they viewed that as being a way that they'd be able to innovate more and really engage in M&A activity and make, expand more easily than they've been able to do in the recent past. And then they were also expecting this extension of tax cuts, which they were going to expire at the end of this year, and even further cuts. But then things have really changed in recent months. So if you think about what's happening now, sentiment among businesses and consumers has really plummeted. And it's interesting because if you look at the hard data on growth and employment, they're still holding up pretty well. But people have just become much more fearful about how the economy is going to fare later in the year. And as you and your listeners know, the source of that concern are the uncertainty caused by the tariffs and the fact that they were on again, off again, and everyone's waiting for later this week on Wednesday to find out more definitive information. The prospects of a global trade war, because it's not only what we do on tariffs, it's what other countries do in response to those tariffs.
So
And then
I
the
think
other thing that adds to that is what's happening with DOGE and the cuts in the federal government. And I think it may not be about the cuts per se, but the way they're being implemented has given some people some, getting nervous about things.
so. I think it's interesting because, in the process of talking about the markets that we have done on our shows here, the common theme is the markets don't like uncertainty. Well, from the Federal Reserve perspective, I think it's safe to say that the Fed probably does not like uncertainty with a lot of these policy decisions as well.
Yeah. Well, I mean, nobody really likes uncertainty. We all would like to know what's coming. And, you talk to businesses today and talk to them about the last time we had tariffs in 2018 and 2019, and they would tell me, look, just tell me what the rules of the game are. I'm confident I can handle whatever the policy is. But if I don't know what the rules of the game are, it's hard to play the game. And I hear the same thing now when I talk to business people. They're all like, I'm pretty confident in my business and I'm pretty confident in I can navigate, but I don't know what I have to navigate. And I think that's part of the problem is that, we all have to make decisions under uncertainty. But this has been particularly uncertain because it hasn't been stable, right? One day it's one thing, it seems like the next day it's something else, and that makes it really hard for businesses to plan. However, I do think that this uncertainty is not going to be resolved. Wednesday's going to come, but there's still going to be uncertainty around things. And I think businesses and policymakers at the Fed and other policymakers are going to really just going to have to navigate uncertainty and be able to deal with it. And personally, my own view is that some of the businesses are going to basically conclude, well, I have to make some decisions here. I can't just wait forever. And I think they will end up making some investments, but they'll be shorter term investments. They won't want to go long, given that things could change, where they think one thing and then it turns out that something else is happening. So I think we'll see it affecting the economy, no doubt. We're already starting to see that uncertainty affect decision making. But we'll have to wait a little bit longer to see how it actually impacts hiring decisions, investment decisions.
Does this
It's a downside risk to the economy, no doubt.
does this start then to bring back the potential, or at least it's being thrown out there maybe a little bit more, around the idea of a potential recession at some point down the road?
Well, certainly the risk of recession has gone up. I mean, if you look at all these private sector forecasts, they've all put a higher weight on the possibility of recession. It's not the base case. Nobody's really projecting that there'll be a recession. I don't think it's the base case. But remember, at the beginning of the year, that wasn't even in anybody's vocabulary. Even though at any point in time it's like a 0.25% chance, 25% chance you'll have a recession just because the economy runs in cycles. Now those percentages are up to depending on which one you're looking at, 30%, 40%, even 50, a little under 50% in most forecasts. So it's on people's minds now. And it's even worse than just recession. It's like a recession caused by uncertainty. And then coupled with that, there's upside risk to inflation. So you get this bad situation where, especially from the Fed's point of view, where you could have growth slowing, labor market weakening, and at the same time, inflation not coming down and maybe even going up. So that's a bad situation for the Federal Reserve because, of course, it has a dual mandate of maximum employment and price stability, and you'd have sort of those working against one another.
So then that brings into the question once again about the potential of rate cuts at some point this year. I think a lot of the expectation has been maybe two, maybe one around June and one later in the year. Where is your thinking on that potential right now? And maybe to a degree that's still a little bit up in the air depending on what happens here.
Well, obviously, the policy is going to depend on not only what happens, but also the outlook for the economy, because as you know, the Fed policy doesn't affect the economy right away. It has some lag in it. So they're going to have to be looking out and sort of making their best estimates about, where the economy is going. But look, there's two scenarios that would call for further reductions in the interest rate this year. Right. So the first one is what I'd call a benign scenario, which is the, sort of stubborn inflation numbers we've seen at the beginning of the year turn out to be sort of either seasonal or just, not really lasting. And we get inflation moving back down again. And it turns out the tariffs are like one of changes in the price level and they don't become inflationary. And so the Fed could, in that scenario, return to its policy that it was doing in the middle of last year, which was beginning to bring the rate down from restrictive levels to more normal levels. But the other way that the Fed will be, putting rate cuts back on would be a less happy scenario, which is basically the economy is beginning to slow quite a bit. And, they have to sort of make that balance between inflation and maximum employment, and they see that the economy is weakening enough that it begins to have to do those rate cuts to really support the economy. And that one is becoming more likely in forecasts, that the Fed's going to have to take some action because we're going to see the unemployment rate go up, labor markets weaken, growth slow down, and so they're going to be cutting. Now, I doubt I don't see that things could change so quickly that they would want to start that in June, but it could happen. And, they're going to be forward looking and they're going to want to look at the balance. I think a better strategy would actually be, given that we've seen inflation readings being elevated and we've even seen increases in inflation expectations, which are not welcome at all, would be to be on hold at the current level for long enough that you could actually make sure that those inflation expectations really are well anchored. And then if you do see the economy and evidence that the labor market is weakening, then be more willing to cut at a faster pace than they typically are willing to do. Because that way you're sort of doing the balance between inflation, which they've made all this progress on inflation, bringing it down. It's not back to 2% where they need it to be. You wouldn't want to give that up. At the same time, they have to take into account that there's a dual mandate and the employment side of the economy is very important. So it's a hard balancing act. And, not everyone on that committee is going to have the same view of how to balance those two goals. And so that's what's going to be, what the Chair Powell is going to have to do is really, gather all the information he can from around the country, and that's what the Fed presidents do. They bring that to the meeting, and then come up with the best path forward that tries to balance those risks, hearing different views on different sides of the table. And that'll be, I think, the challenge for the Fed and for the chair.
Loretta, great to have you with us today. Thanks very much for your time and your insight. All the best.
Thanks. You too.
Thank you. Loretta Mester, former Cleveland Federal Reserve president and now an adjunct professor of finance here at the Wharton School.